Tim, welcome back.
Hey, buddy. Good to be back.
So a lot of talk about the UK today when I guess, some ugly Americans want to distract from the downgrade that Fitch gave U.S. debt yesterday.
Yeah, I mean,
is that top of mind for you at all, Tim?
What, the Fitch downgrade? No, not at all.
Yeah.
Not at all. No,
Okay.
it's an absolute sideshow for me, that, mate.
Okay.
I mean, I just don't. These guys, I don't know. They sometimes I think they just want to stay relevant.
Okay.
It makes no sense to me at all.
All right, because who did it in 2011? Was it
S&P?
Moody's?
No, Standard & Poor's. Yeah, Standard & Poor's. Yeah.
Okay, they got their ass sued.
Yeah. Oh, yeah. They got themselves in big trouble. Yeah.
Yeah. I wonder what's going to happen to Fitch now. Maybe it's a short, the stock.
Yeah. Good point. Good point.
Anyway, so I mean, based on that precedent, it takes some courage to come out and say what's really happening. And
yeah, I mean, I don't know that it does. I don't know. I mean, I think to anyone paying attention, it's been kind of obvious. No, it's not sustainable. This deficit spending isn't sustainable. Right. I think everyone knows that.
Yeah.
But why now? Why now? Why not like a year ago?
I don't know. Maybe it's because there was some hubris with the fact that they were able to negotiate a debt ceiling deal without a ceiling for a few years. And they thought mission was accomplished, that they averted a financial crisis when all they did was delay it or exacerbate it.
Yeah, maybe. I don't know about a crisis, but I do think there's a slowdown.
A lot of supply.
A slowdown in its way. Yeah, a lot of supply. That's really what I'm watching at the moment. That's really got my eye, the bear steepening side of things that we're kind of starting to see.
Yeah, so today we find out what the mix is. I'm hearing they're going to go a lot heavier bonds.
Yeah, it's just literally being released now. Actually, I'm just trying to get the.
Okay, there's 10-year yields pushing up.
Small increases in refunding needs. Sorry to.
Okay. Thank you, mate. So yeah. So it's all pushing up, and I think the difference this time from the last refunding was obviously that they've got their rules on roughly the balance. Yeah, it was mainly bills. Yeah. A lot of that was taken from the RRP. So the reverse repo facility. So they've got that sat there, I suppose, as a kind of slush fund, and you can kind of interchange, loosely speaking, between them. But obviously they can't just keep issuing bills. They have to issue some longer duration stuff as well. And now I think we're seeing that perhaps at the worst possible time of that supply coming into the market, when we've got Japan, who are, basically they're doing their own thing. Because the problem with the dollar strength from a foreign buyer side of things is that it takes away a lot of that yield. If you're in Japan, you've got currency risk, and the currency risk, when you hedge it away, it really brings down your yield from investing in US instruments. Like if you take the 10-year, for example, until recently, you were roughly the same if you invested in a 10-year Japanese government bond, or if you were hedged buying a US government bond. Okay, talking around about the 10-year mark. Okay, so now obviously with Japan letting their yield fly a little bit, we're up to around about 0.62% now on the 10-year, and in theory they're going to allow it to gradually move towards 1%. There's kind of that natural buyer is taken away from the US market. Or when I say taken away is too far, but mitigated. Their influence is less, it's not as attractive, which generally means that the yield needs to be higher to bring them in.
Doesn't that make the carry trade unwind that people use to buy everything?
I mean, again, when you think about it, if you can still borrow cheaply in yen, it's it's still the cheapest one. I think it's again the unwind of the carry trade is coming, and we're starting to see some of the emerging market, I say emerging markets, really Latin America. Those central banks are starting to cut rates because the economy's slowing, inflation's lower, so they don't, rates don't need to be as high as they are in. I think it was Chile the other day. Brazil are expected to do it today as well. I think by 50 basis points, and it's just sort of that kind of thing. It might be the start, just a little bit of it. And then if we get a real bout of risk off, obviously, everyone's short yen all at the same time. We've seen this movie before.
Yeah. So, last week was big in the end. the 138 level was very important.
Yeah.
Right now it doesn't look terrible. Almost looks like it's gonna go for these highs.
Yeah.
With people buying their story, right? Buying the story that they're gonna let, yields go up, and they have gone up a bit,
But again, I think there's a layer underneath.
That's not a bearish looking chart to me.
No, not in the slightest. Not in the slightest. Yeah. I think the thing is a lot of people thought that, okay, so as soon as it's I like to think about this in kind of like you've got your first order consequences and your second order consequences of different things. And a lot of people tend to get caught out thinking only, okay, like for example here, okay, so in Japan, they're going to basically bring, get rid of yield curve control at 0.5%, and they're going to put it at 1%. Okay, so therefore, that means that the yield differentials will narrow and the yen will rally. All right, and we saw, that got priced in advance of the event, and now here we are, and the yen after that, and the yields are rising. The yen isn't strengthening, and I think what we're seeing, I think that's the other side of this again of buying the US debt. So the actual yield differentials are actually widening again because you haven't got the Japanese buyer, or you're anticipating that you're not going to have the Japanese buyer to the same extent. So in actual fact, the US and Japanese yield differential, which tends to drive the currency more than pretty much any other factor, it's widening. So if that continues to happen, then I think we see dollar yen higher.
Yeah, challenging the highs. I mean, it was a confirmed high up there, and this was a failing rally from the, if we want to really get macro, the 152, the intervention that the BOJ made a lot of money on this intervention. So maybe
spend a lot of money down. Spend a lot of money.
Yeah, but that was don't say intervention doesn't work. I think the jawbone by the Fed helped. They came out on a Friday and said, rates may not go up much longer, and that actually helped. Remember that? I do.
Yeah. Lovely little coincidence, and now here we are.
I think the whole market, Tim.
Yeah.
The whole market is going to be everything. The linkage is to everything with the yen right now. That's the way it feels to me when it technically is that it is the focal point for either a continuation of risk or the unwinding of risk. And it's all going to be about the yen. Am I crazy?
I don't think you're crazy, but at the same time, I look at the yen more as a passenger of all of this. Okay, I think that essentially by the time we are going to say, okay, now's the time to be long yen, everything's pretty screwed. And until that date, whenever that time comes, which generally is going to be the time when people are rushing for longer bonds and trying to lock in the yield and just sit out of the way for a while. Then I think that's the point when we're looking at yen coming down. Yen strengthening and the dollar yen coming down.
Is it possible that the bonds don't rally? I mean, typically you would look for bonds to rally under that circumstance, like they used to.
Yeah, I think they will once it's clear that the economy is really rolling over. And I don't know. There's plenty to be worried about in the economy. And just look at the manufacturing sector. You look at the data coming out. It's not looking incredibly good, but at the same time, it's not really rolling over. Where are the job losses? The ADP numbers, I know they're not the best, but you look at those numbers coming through, and they're big. NFPs as well, they're well above. So they're right up there around that sort of 200,000 mark every month. On average.
You want to buy this chart? This is a TLT 20-year Treasury proxy. You want to?
Not yet.
Is this a bullish looking chart to you?
No, it's not a bullish looking chart at all. What would you look at on that chart that's bullish? Nothing. Absolutely nothing. And I do think that we're going to get that. At the moment, the big risk for me for risk markets, ironically, is that we actually see the longer yields kind of push out. And we get that some of that term premium back.
Maybe we're going to come out.
Maybe not that far. But yes, I think we can. I think the two ends are kind of. I think if you how can I sort of explain it? You kind of obviously at the moment we've got quite a deep inversion, and I don't think that we can come out of the inversion entirely with the short end staying exactly where it is. Without us starting to price in some cuts, because I think if we really push those yields up at a time when the economy is slowing as well. I think at some point people are going, no, this isn't sustainable. You know, going into 2024, you know, there's a lot more refinancing, a lot more going on there.
Yeah.
You know, with high yields across the curve, you know, high yields across the curve. Just say, for example, you've got 5%, you know, on the 10-year, just chucking it in there, you know, and
I think
it's
that's
like,
possible.
wow, that's going to kill everything. And I'm going to grab it because we're just going to die here if I don't, you know, the economy can't handle that, in my opinion.
Okay. So if we go to 4.9 into year end, it's over.
I would say so. I would say so. I mean, because it
for
raises the
24.
benchmark for everything else, Dale, as you know. It's the risk, you know, it's the benchmark risk-free asset. Obviously, ironic that it's sold off so much as it has when it's called a risk-free asset, but you know, it's the benchmark for everything else. And if you can just sit in a 10-year bond, you know, and earn say 5% yield, then it just raises that bar. It raises that bar a little bit higher for taking on the higher risk. You know, and obviously the stock market hasn't, you know, there's plenty of juice already in there. I don't know necessarily that it's going to roll over immediately, but you know, again, it's an alternative. You know, we're just always competing for capital, you know, between markets, and you look at the relative attractiveness of them all. I mean, stocks generally everywhere are pretty much, you know, they're near the highs, you know, whereas bonds are very much near the lows. Yeah, there's that sort of attractiveness is they're entirely at different ends of the spectrum, but that doesn't mean that we're necessarily going to say, right, today's the day. You know, we're just going to flip from one to the other, because obviously it's still only 5%, and a lot of funds and investors have to try and make more than that. You know, they've all got their mandates to meet. So yeah, interesting times, and I do think the dollar is the one to watch above all else.
It's a wrecking ball, and it's relentless.
Yeah,
you know,
I think it can do a lot more.
It gave you one good correction last week to buy this dip.
Yeah.
And if you're waiting for a dip, it's not, you know, it is not accommodating people.
No, not at all.
So, and I think a lot of people are trapped short the dollar, because they called this the great breakdown and the end of the dollar as a reserve currency. I hear targets like 84 and, you know, all over the place. I think we're going to 108, Tim. In the dollar.
Yeah, I could totally see that. I mean, again, right, you look around and you say, okay, so you know, I like to use the dollar smile a lot as a framework, you know, and you look around and say, okay, so relatively speaking, is the US economy going to do better or worse than other economies? And you look around, you look at the UK, you look at Australia, you look at Europe.
Cleanest dirty shirt again, right?
Again, as it always is. It's the largest economy, no matter what Fitch does. I mean, the stupid thing with the Fitch rating, just going off on a tangent there as well, is like, if the US isn't creditworthy, okay, you know, and you're saying, okay, they're not as creditworthy as Germany, and naturally we get to a point where we've got to worry about the creditworthiness of the United States, then all of the other ratings are irrelevant entirely, because then none of the other economies are anywhere near the size, the scale. They haven't got the dynamism, nothing compared to the US economy. So if the US is worse than them, then it can only mean that they're kind of, I suppose, mispriced, to use a trading term. Just completely.
Okay, what do they have in Europe that would be similar to Fitch and Moody's and rating agencies? And
nothing anyone listens to, Dale.
Really, nothing.
Well, I mean, you barely listen to, well, at least for me, I barely listen to Fitch and Moody's and all of them. So you know, it's like when they come with their ratings, man. Because you're talking about governments, they can print their own currencies, man. How are they going to default? You know, they might. There's risk there of obviously devaluation, but there's not a risk of default. So what's the point? Yeah. I saw someone suggest that actually Microsoft might be a better bet. You know, and it's just, you know, just different worlds, man. Different worlds.
Microsoft is topped as one of the first ones to do so.
Yes.
So we'll see.
Very interesting.
You know, what I'm looking at, and people, you know, this to me was a poster child for AI and the huge spec rally we had.
Yeah,
I think
massive.
that Nvidia's topped. There's a 3 drive. It's tried to make new highs. Under 440, it's got problems. So I think that, you know, a lot of these things are going to do gap fills. You know, they had a lot of earnings gaps, so that's what I'm looking for.
That's a nice, I mean, that's a nice big gap down there. But yeah, I mean, I kind of find with a lot of these kind of stocks, I watch them and everything else, but I don't really find there's opportunity in them a lot of the time, just because you've got such kind of, I suppose, you know, like countervailing forces. You know, there's like, you know, you've got the AI sort of mania, if you like, on one side, and then you've got the you know, you're trying to short that and go, this is ridiculous. I just
So the
prefer in
better
those
shorts,
situations, I just prefer to sit out and find something else. There's so many
okay,
markets.
like Amazon, you know, S&Ps are at new all-time highs, Apple's at new all-time highs, right?
Yep.
And you look at something like Amazon, and to me, it looks like a bear market rally, and not even close, just a retracement. So your best shorts are things that did not make new highs during this blow off, and they could make new lows, while we could just get pullbacks and the other stuff. Anyway, you don't think
Yeah.
there's
I don't
any
know. I kind of like Amazon in a,
Do
here.
you?
Yeah, we'll have to see what the
Alright.
earnings do, obviously. And they're
All
just
right,
down
yeah.
that little bit. But yeah, I mean, because you think, again, if everything goes, it's like, okay, so let's try and work through this. So if everything goes wrong, okay, should we say, if we're worried about the future of the economy and everything else, then you start to look to the companies that can generate the highest cash flows.
Okay, so
And
that's
Amazon is among those,
like COVID.
Yeah, kind of
During
similar to what we saw with COVID. Yeah, I mean, they're not necessarily immune to a bit of a sell-off, but I just think that they're more likely to be bought up again because they are, they are sort of so integrated into the entire economy.
I'm glad I brought it up.
Yeah, so I'd look at them in that sense, definitely. And obviously, I think you actually got a lot of stocks that are lower quality that have been built up. That have been a lot of short covering. It was I saw commentary both from Goldman Sachs and from JPM in the last couple of days, that's from their prime brokerage, saying that they'd seen massive amounts of short covering and sort of basically capitulation of shorts from hedge funds. So I mean, I think that kind of says a lot about where we are now. That the towel has been thrown in on those shorts for a lot of them, but that doesn't necessarily mean that they're just gonna, they're gonna put those shorts straight back on again. It just shows that we've probably run out of fuel. Yeah, we've used that fuel up. Exactly. So now we need a bit of positivity. And I'm not saying that we're definitely gonna, that we're gonna get it, but I mean, just imagine, like, if you look around, if inflation sort of settles, okay, around about this kind of level, around about 4%, 3 and a bit, that kind of thing, which I think is quite likely for a little while because energy prices are starting to push higher again, and you're just kind of getting that kind of push through of the base effects kind of being priced out from before. So the bar is lower, if you like, to get those sort of inflation beats. So obviously before we had the really high inflation over these last few months, like a year ago, but now they're out of the comparison.
And that's what I brought up early in the week, was with all this great inflation news that we've had. Why is a 10-year at 4.04 instead of at 3.30?
Yeah, exactly. And that's because it's not done yet. We haven't played it out yet. It's as simple as that. And, and the US government is still spending. I mean, they're talking about $1 trillion issuance.
Right.
It's just like that's a lot of money. And that money, obviously, it finds its way back into the economy. The government doesn't just take it out and park it somewhere. They're doing that and they're spending into the economy. They're spending, they're paying their employees wages. They're, spending on social security and all those kind of things. It's all going back into the economy. So, I don't like a lot of things that I'm seeing, but at the same time, I just think we're stuck in this kind of uneasy equilibrium for now within markets, but where the obvious trade for me is the dollar, as long as nothing goes terribly, terribly wrong. I just can keep seeing that as the cleanest shirt, because again, if everything goes wrong, you favor the dollar. If everything goes right, the US economy probably outperforms everyone else. So that's kind of how I'm looking at it.
Okay, well, normally a stronger dollar depresses most other asset classes. It hasn't really gotten to stocks.
Yeah.
You have a view on metals at all, Tim?
I honestly, the metals I'm really not that great at. I generally think that metals should be lower based on the real yields, but obviously they haven't been. That for me, always makes maybe I don't know.
Right.
That's what I mean. I always get stuck with the metals because it's you had that model for them in a low yield environment before, and now it's just sort of broken down. It's kind of like what's more important? Is it kind of currency debasement because of inflation? Is it deficit spending? And what's more important? What's the driver? So yeah, for me, it's just a kind of an in and out type of thing when it comes to the metals. There's no real fundamental view, just to kind of overstretch one way or the other and think, yeah, that makes sense there to go short or long.
So the dollar goes up and we have a swoosh and everything else.
I mean, potentially.
Yeah.
I mean, sometimes the dollar can go up a bit along with the stock market.
Yeah, yeah, it's true.
You
It
know,
did.
and then it will
Yeah,
weigh on
I've
the
seen-
earnings in the future if it stays strong. But
Yeah,
if it's fun, if it's flows coming into stocks, into US stocks, again seen as the cleanest and the, and the best companies, yeah, you can see inflows into the US economy. And again, with the yields higher, it kind of makes sense that you'd have that as well.
yeah. Well, Tim, I get your free newsletter,
Good.
and I think that other people should do that too. So
I agree with you there, Dan. I agree with you. We try and make things understandable for people. Yeah, if you go down there to macrodesiac.com.
Okay, so here you go. There's a picture of Tim. He's a pirate, so be careful. Just
it's my
enter
spirit
your
animal.
email.
My spirit animal there, Jack Sparrow.
And you know what I like about you, Tim? You do a lot of you're like a gumshoe. You go to all these conferences. You're on the move, seeking out what people are presenting, and then dissecting it and giving your view on it. I think it's excellent. So it's
Thank
free,
you, man.
everybody. So you could just go to Tim's website. And Tim, I learned things from you. I really like the term that the end is a passenger instead of the train. Yeah, that's really good, nice metaphor. And thanks for giving me balance on Amazon.
Tim's a good egg, Dale. I'll speak to him a lot on the old prayer.
All right, so you and Ryan.
Thanks, Ryan.
Couple of
likewise,
Brits.
mate.
Yeah, so
Cheers,
really, you edify people when you speak and when you come here to face. We appreciate it, and have a great summer, Tim.
It does sound like there's a bit of education needed there, though. I don't know how we're going to teach Blake about these British words. I don't know.
Wait a second. Wait.
Yeah, he's in detention right now.
That is like
for breaking a rule.
If you came to the United States and you said you'd start, I'm sure there's a few words we could find, and I'd be like, oh, you can't say that.
There's nothing you can't say. There's nothing you can't say.
Let me test you, Tim. See if you remember this. Do you remember the first time that word appeared on US telly? It's one of those stupid facts that you retain.
Oh, mate, no, I haven't got a clue. Go on.
Were you old enough for Miami Vice?
Yes.
Oh,
yeah,
really?
yeah.
Phil Collins starred in Miami Vice once, and he said it. And it was a big thing in the UK in the press and everything, because Phil Collins said wank on American TV.
I loved it.
And no one knew what he meant. Yeah.
Anyway, instead of saying "see you, my trading warrior brothers," I'll say "see you, mate."
All right. See you, mate. Cheers, Dale.
Thanks, Tim. Ryan, Blake, you're
Cheers,
a bad boy today.
Thanks, gentlemen. Thank you, Tim.
All right,
Take care,
everyone.
guys.
Team, have a great day. Everyone that was here, we'll see you tomorrow. Good hunting. Join and get in the chat room. Do it now. See you guys.
Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.